Imagine finding a way maybe to potentially boost your investment returns, like a simple strategy, perhaps even a bit counterintuitive, using some of the biggest, most established companies out there, the ones you see, interact with, basically every single day.
Right. Household names.
Exactly. And this approach, it has this name that's instantly memorable, maybe even a little quirky, the dogs of the Dow.
It really does paint a picture, doesn't it? You think maybe underdogs, companies that feel a bit neglected, maybe temporarily out of favor with the market. But, the name is quite deliberate. It's tied to the strategy's core idea.
Which is?
Focusing on a specific group of stocks within a major index, the Dow Jones. That might look like dogs based on one particular metric, but proponents think they've got this hidden potential, poised for a comeback, maybe.
Okay, so it's not just any old low-performing stock. Often these are like blue-chip companies whose stock price has dipped.
Exactly. And that dip, as we'll get into, has a very specific effect on their dividend yield.
Right. So our mission here in this deep dive, using the sources you've shared, is to really unpack this specific investment strategy. We want to look at where it came from, how it actually works, step by step, look at those claims about its historical performance.
Which are often quite impressive sounding.
They are, but critically analyze what your material tells us about whether this strategy is, still barking today. Is it still working? Is it delivering those effective above average results for investors in the real world?
Yeah, and the sources we have here, they don't just describe it. They really dig in. They examine those claims, look at potential flaws in the data, the impact of real world costs.
Things like taxes, transaction fees, often overlooked.
Exactly. Things that get missed in the simpler explanations. And they look at periods where, frankly, the strategy just hasn't performed as advertised.
So it's a chance to get beyond the elevator pitch.
Absolutely. Get to the analytical heart of this dogs of the Dow idea.
Okay, let's definitely unpack this. So first off, for anyone maybe new to this, what is the dogs of the Dow strategy fundamentally?
At its core, it's a very specific rules-based investment approach. And it limits its focus exclusively to the stocks that make up the Dow Jones Industrial Average, the DJIA.
And the DJIA, why start there? What's significant about that index?
Well, it's one of the oldest and certainly one of the most widely recognized stock market indexes in the U.S., maybe the world.
Everyone knows the Dow.
Pretty much. It's only 30 stocks, which sounds small, but they're carefully selected. Big, influential, historically significant companies trading on the major U.S. exchanges, NYSE, NASDAQ.
We're talking household names, industry leaders, blue chips.
That's it. And while it's just 30 stocks out of thousands, it's often seen as a proxy, a barometer for the overall U.S. stock market's health.
Right.
So you're starting with this small, visible pool of really well-vetted major corporations.
Okay. Companies that have been around, giants. Now, you mentioned it has a history. Where did this specific strategy come from? The sources say the 90s, but maybe the idea is older.
That's right. It really hit the mainstream consciousness in the 1990s, mostly thanks to Michael O'Higgins and his book, Beating the Dow.
Okay.
But the underlying idea, the theory, it actually goes back further. Our sources mention similar concepts, observations about high-yield Dow stocks, appearing much earlier.
Like when?
Well, there's mention of analysis in the Journal of Finance way back in 1951.
Wow, 51.
Yeah. And the Wall Street Journal discussed it in the early 80s, too. So the basic observation that high yielders might be an opportunity wasn't totally new, but O'Higgins really systematized it, gave it that brand name in the 90s.
Got it. An old idea kind of packaged into a modern strategy. But the appeal, like you said, is often its simplicity. So how does it actually work? Can you walk us through the mechanics year by year?
It is designed to be really straightforward. That's definitely a big part of why people like it, especially investors who want a more hands-off mechanical approach. So here's the annual process based on the material. First, timing is specific. You do the analysis right at the end of the trading year, after the market closes on the last trading day of December.
Okay, I need the final numbers.
Exactly. Closing prices, dividend info for the whole year, for all 30 stocks currently in the DJIA.
End of year, check the 30. Got it.
Second, from that list of 30, you identify the 10 stocks that have the absolute highest dividend yields, based on that year's data and those closing prices.
And just quickly, remind us how dividend yield is calculated.
Oh, sure. Simple calculation. You take the total annual dividend per share the company paid out.
Right.
And you divide it by the stock's current price per share. Express it as a percentage.
Okay.
So, for example, if a company paid, say, $3 in dividends over the year and the stock price ended at $50, the yield is $3 divided by $50, which is 0.06 or 6%.
Makes sense.
And The key thing is the yield moves when the price moves, even if the dividend payout itself stays the same. If that same stock price dropped to $30, but the dividend was still $3.
The yield goes up.
Right. It jumps to $3 divided by $30, which is 0.10 or 10%. So a high yield can often mean the stock price has fallen, assuming they didn't cut the dividend.
That example makes it super clear. So calculate for all 30, sort by yield, pick the top 10. Then what?
Third step. Once you've got those 10 highest yielders at year end, you wait until the first trading day of the next year.
First day back after New Year's?
Pretty much. On that day, you invest whatever amount you've decided on into those 10 stocks, but you allocate an equal amount of money to each one.
Equal weighting, that's important.
Absolutely crucial. It's core to the structure. The sources use that simple $10,000 example. You'd put $1,000 into each of the 10 stocks.
Okay, $2 K in each of the 10 stocks.
Exactly. Fourth, and this requires discipline, the commitment is to hold those exact 10 stocks for the entire calendar year.
The whole year, regardless of what happens.
Regardless of performance during the year. You don't react to news, you don't sell if one drops, you don't take profits if one soars. You just hold for 12 months.
Wow, okay. Patience definitely required there. You're kind of locked in for the year.
You are committing to that portfolio for the full year. Precisely. And then fifth, at the end of that year, the whole cycle repeats.
Rinse and repeat.
You got it. Last trading day of December, look at the current 30 Dow stocks. Find the new top 10 highest yielders at that point. Sell any stocks from your portfolio that are no longer in the top 10. Buy the new ones that made the list.
Yeah.
And rebalance the ones you're keeping back to that equal weighting for the start of the next year.
So it's this annual ritual. Hit the reset button every January. And the sources really stress how simple and low effort this is supposed to be.
That's right. It's mechanical. Needs attention just once a year. The list of Dow stocks, prices, dividends, it's all readily available online everywhere.
Easy to find the data.
Super easy.
Yeah.
Calculating the yield, finding the top 10. You could do it with a spreadsheet, even a calculator, in a few minutes. Buying and selling is quick these days with online brokers.
Yeah.
It's presented as something you can knock out quickly around the New Year holiday, leaving you time for other things. That perceived ease is definitely a big part of its appeal for investors who don't want to be glued to screens day trading.
All right, the how is crystal clear. Simple, mechanical, once a year. But let's shift to the why. Why, theoretically, should picking these specific high-yielding dogs actually work? Why should it deliver strong returns? What's the logic, according to proponents?
There are a few key pillars to the rationale. First, proponents say because you're picking only from the 30 Dow Jones stocks, you're starting with inherently resilient companies.
Okay.
These are usually huge, established corporations. They have market power, recognized brands, global operations sometimes, better access to credit than smaller firms.
They've got resources.
Deep management talent, R&D budgets, ability to make acquisitions. They can weather economic storms better typically. The idea is these blue chips have staying power, less likely to face, existential threats.
Okay, so starting with quality companies, but then you pick the ones with high yields. Doesn't a high yield often mean a company's maybe in trouble? Price falling?
And that's exactly where the contrarian angle comes in. It's critical to the theory, like we just discussed with the calculation. A high dividend yield often pops up after a company's stock price has taken a hit, a significant decline.
Right.
The dividend payout itself might have stayed stable, or at least didn't fall as much as the price did.
So the lower price inflates the yield percentage.
Bingo. For one of these established blue chip companies, that high yield relative to a recently lower price, well, you can suggest the market might have overreacted.
Overreacted.
Yeah, to some negative news or maybe short-term challenges for the company or its sector. It implies the stock might just be temporarily out of favor, potentially undervalued or oversold based on general investor feeling. The strategy theorizes that buying them when they're down gives you a shot at benefiting from a potential price rebound as the company recovers or market sentiment shifts back.
So it's like finding a quality item on the clearance rack because of a temporary issue, not because it's fundamentally flawed.
That's a great way to put it. And there's more. The fact that a big Dow company is willing and able to keep paying a relatively high dividend, even when its stock price is down, that could be seen as a positive signal from management.
How so?
It can suggest confidence. Management believes in the company's ongoing profitability, its future cash flows. They're willing to return capital to shareholders, implying they think they can keep earning enough to support that payout, even through tough times.
Okay, so the high dividend signals potential value and management confidence. Two birds, one stone.
Kind of. And the hope for investors is to benefit from both things. Potential stock price going back up, that's capital gains, and collecting those relatively high quarterly dividends as income while they hold the stock.
Makes sense.
One source even brings in this market overreaction hypothesis. A study suggested the strategy might tap into investor psychology, how people tend to overreact to bad news, pushing prices of good companies down further than maybe makes rational sense.
Creating those opportunities.
Creating those high-yield opportunities for contrarian buyers, yeah.
So the theory is find solid companies in a temporary funk due to market mood swings, buy them at a discount relative to their dividend, and you're set up for both income and a price recovery. It does sound pretty appealing.
It is. That intuitive logic plus the simplicity, powerful combination for its popularity.
And based on that logic, proponents point to historical data. Claims of impressive performance. Sources mention backtesting suggesting outperformance. What do those historical claims actually look like?
Yes, advocates definitely lean on historical backtesting. Some early research, especially linked to O'Higgins, suggested that if you'd followed the dog strategy consistently over really long periods, maybe even back to the 1920s,
Wow.
it showed this pattern of consistently outperforming the overall market indexes, even the DJIA itself.
Consistently outperformed. That's a bold claim. Definitely grabs your attention.
It absolutely does, and the sources you shared have specific data points often used to back this up. For instance, look at a pretty significant 20-year stretch, 1992 through 2011.
Okay, 2 decades.
The dog strategy reportedly matched the average annual total return of the DJIA index. Both came in around 10.8% per year on average.
Match the benchmark.
But even better, over that same period, they're cited as having outperformed the broader S&P 500 index. The S&P averaged 9.6% year then.
So matching the Dow, beating the S&P 500 over 20 years, sounds pretty good on the surface.
It does. And the sources also mention a variation sometimes called the small dogs of the Dow or puppies of the Dow.
Oh, small dog.
Yeah, this involves picking just the 5 lowest priced stocks from the main list of 10 dogs.
Oh, okay.
According to the data cited for that same 1992-2011 period, these small dogs did even better. Reportedly delivered an average annual return of 12.6%.
Better than the main dog strategy in the indexes.
That's the claim for that period. Plus, the official Dogs of the Dow website, which tracks performance live since 2000, is also mentioned as showing data suggesting the strategy has continued to do well since then.
So the story from proponents is simple strategy, real bite, generated superior returns over long stretches, and the emphasis is always long-term.
Always. That's the key message from proponents, even when they admit there's short-term volatility. Success relies on the average performance over many years. Don't expect it to win every single year.
Right.
It's the cumulative effect, the average gains over long horizons it supposedly delivers. You have to stick with it through the down years. Discipline is key.
Okay, we've laid out the strategy, the theory behind it, the historical claims of success. But like we said, this is a deep dive. We need to look at all the material. And your sources also present some pretty significant counterarguments. Some even call the strategy a myth or cast doubt on its effectiveness. Where do these critiques focus?
Yeah, this is where things get really interesting, and the sources provide some rigorous examination. The main critique boils down to this. That picture of consistent outperformance, while it sounds simple and appealing, well, it changes quite a bit when you adjust the analysis for factors that are often overlooked or minimized in the popular versions.
Okay, so it's not just challenging the raw return numbers themselves.
Oh, far from it. The critiques look into potential issues with the actual data used in some older studies, the really crucial impact of costs, things that eat into real-world returns, and the inconsistency or even a negative performance seen in more recent times or under stricter analysis.
Let's start with the data then. Sources mention flaws in data and measurement in some earlier claims. What kind of issues are we talking about?
This is a pretty fundamental challenge some critics raise. They suggest some of those really impressive return figures you hear might be based on flawed, maybe inaccurate data. One source gives a very specific example. There was an analyst, John Slatter, who discussed the method in a '88 Wall Street Journal piece. He presented data suggesting a portfolio of high-yield Dow stocks gained this eye-popping 7.59% per year edge over the DJIA itself.
Okay, almost 8% better per year sounds amazing.
It does.
Yeah.
But the critique points out a massive error in Slatter's data for a key year. He claimed the DJIA returned positive 44.4% in 1974.
Wait, a gain of 44% in 1974. That year was rough, wasn't it? Oil crisis, recession fears.
Exactly. It's completely wrong. As the critique notes, the U.S. stock market, the DJIA included, fell sharply in 1974. The actual return was heavily negative. The source doesn't give the exact negative number, but the point is, claiming a 44.4% gain for the benchmark was just flat out incorrect. The market tanked.
Wow. If a basic number like the benchmark return for a major year is wrong in an analysis claiming huge outperformance, that really makes you question the whole thing, doesn't it?
It absolutely does.
Yeah.
If one key input is wrong, how reliable are the other numbers in those early reports? The critique argues that this perceived premium might be seriously overstated in popular accounts because of things like data sampling problems, coding errors, and the bias of arithmetic averages.
Okay, bias of arithmetic averages. You mentioned that briefly. Why is using an arithmetic average potentially misleading for investment returns over time?
Right. This is super important for understanding how performance can be presented, sometimes deceptively. An arithmetic average just adds up all the annual returns and divides by the number of years. Simple math.
Yeah.
So you had returns of plus 100% one year, then negative 50% the next, then plus 20%. The arithmetic average is 150 plus 20. 3 equals 70. 3 equals 23.33% per year. Looks great.
Right.
But that doesn't reflect your actual compounded growth because the gains and losses apply to a changing base amount each year.
Right. Losing 50% after doubling wipes out the game.
Exactly. Let's track the money. Start with $100 plus 100% makes it $200. Then negative 50% on that $200 bring you right back down to $100.
Yeah.
Then plus 20% on that $100 makes it $120.
So after 3 years, you're only up 20% total.
Right. Not 23.33% per year compounded. The correct measure is the geometric mean return. It accounts for compounding. It tells you the steady annual rate that would get you from the start value to the end value.
And what's the geometric mean in that example?
The calculation is ending value, beginning value, raised to the power of one number of years minus 1. So $120, 13.1. That's roughly 1.06271, which is about 6.27% per year.
Whoa, 6.27% versus 23.33%. That's a massive difference.
Huge difference. Using the arithmetic average makes volatile strategies, ones with big up and down years, look way better on paper than they actually performed in growing your wealth.
And the dog strategy, focusing on potentially beaten down stocks, might be volatile.
Could be, yeah. They might be more volatile as they hopefully recover. So the critique recalculated things using the geometric mean for the Dow dogs versus the DJIA over a long stretch, 1961, 1998.
Okay, what did they find?
Before factoring in any costs or taxes, they found the geometric mean for the dogs was 13.13% a year. For the DJIA, it was 11.35%.
So still an advantage, but much smaller.
Yeah, an average geometric advantage of about 1.55% per year. Still positive, but way lower than that nearly 8% figure claimed earlier using potentially bad data and arithmetic averages. Just fixing the math and maybe the data errors shrinks the supposed edge dramatically.
Okay, so even the raw historical outperformance is significantly challenged, but that's before costs. And the sources really hammer home that ignoring costs is a huge flaw when evaluating real-world performance.
This is absolutely critical. This is where the rubber meets the road for actual investors. You have to consider what it costs to actually do the strategy year after year. And for the dogs of the Dow, its very nature means taxes and transaction costs can chew up a lot of any potential gross advantage.
Why are these costs particularly tough for the Dow dogs compared to just, say, buying and holding the whole index?
Let's break it down. Start with transaction costs. The strategy requires annual rebalancing. It's not optional.
Right, the annual reset.
Every year end, you have to find the new top 10 dogs. That means selling the stocks that fell off the list. It means buying the new ones that joined. And importantly, even for the stocks you keep, the ones still in the top 10.
You have to rebalance them.
Yes. Back to equal weighting, because their values drifted during the year. If one dog doubled and another stayed flat, you'd have to sell some of the winner, maybe buy more of the laggard, just to get back to that equal 10% allocation for each. Plus selling the drop-offs and buying the new covers.
That sounds like a lot of trading activity every year.
It is. One source estimated, based on history, that on average, about 3 out of the 10 stocks get replaced each year.
So 30% turnover just from replacements.
Minimum. Selling 30%, buying 30% new, plus tweaking the other 7. The source puts the minimum annual portfolio turnover rate around 30.27%. That's significant churn.
And every trade costs something.
Yep. Brokerage commissions, though they're lower now, they exist. More consistently, there's the bid-ask spread, that little gap between buying and selling prices. Every time you buy or sell, you pay that spread. It's a small cost, but with 30% plus turnover year after year, those small costs add up. The critique estimated this cost penalty was around 0.34% per year over that 1961-98 period.
Okay, about 1/3% shaved off just from the friction of trading.
That's the estimate for that period, and that's just transaction costs. The other big one is taxes.
Ah, yes.
Remember, the strategy explicitly targets high-yielding stocks. That means more of your total return comes from dividend income compared to maybe a growth strategy with few dividends.
And dividends get taxed.
They get taxed often as regular income, which historically and sometimes still can be taxed at higher rates than long-term capital gains. So you're generating more taxable income each year just from receiving those dividends.
Okay. What else on the tax front?
Well, because you have to sell stocks every year for the rebalancing the ones leaving the list, maybe trimming the winners. You're constantly triggering capital gains taxes.
Realizing gains annually.
Exactly. Any appreciation on those stocks you held for the year gets taxed when you sell. You're not deferring those gains for years and years like you might in a buy and hold strategy where you hold something for a decade.
Right. Buy and hold lets gains compound tax deferred until you finally sell way down the road. This strategy forces realization every year.
Precisely. So you're paying taxes more often on both the dividend income and the capital gains from the annual sales.
So transaction costs plus higher taxes.
Yeah.
What's the combined hit according to these critiques?
This is the bottom line from one of the key sources. They found that once you account for both those estimated transaction costs, 0.34% a year, and the tax penalties inherent in the strategy, well, that 1.55% geometric return advantage we talked about earlier, it basically disappeared over the 1961-98 period.
It vanished.
Their conclusion was, under realistic after-costs, after-tax conditions, the Dow Dog strategy performed pretty much in line with just buying and holding the DJIA. Their exact words were, no robust evidence of an average return anomaly once you factor in the real-world friction.
Wow. So the claimed edge, which was already smaller after correcting the math, gets wiped out by costs and taxes over that long period. That's a very powerful challenge to the whole premise of superior returns.
It really questions if any gross edge is strong enough to overcome the drag from trading and taxes. Suggests the net returns might not be anything special.
Okay, so beyond the data accuracy and cost issues, sources also mention inconsistent performance. Periods where it really underperformed. This hits the reliability question.
Yes, proponents stress patience, admit year-to-year variation. But critics point to specific times the strategy really lagged. For example, it apparently struggled during major market shifts or disruptions.
Like when?
Like the late stages of the dot-com bubble, late 90s. Specifically 1998 and 1999 are mentioned.
When tech stocks were flying.
Exactly. Those high-gross tech stocks soared. But traditional blue chips, especially the potentially lower-valued high-yield ones targeted by the dog strategy, they just didn't keep up. The sector focus of the dogs, often financials, industrials, energy, depending on yields, didn't match the market leaders then.
So the dogs got left behind in the boom. What about downturns?
Also struggled, apparently. The strategy reportedly underperformed during the 2008 financial crisis, too. A time of huge stress for many big established companies, including some that might have become dogs as their prices fell and yields rose. In these big downturns or periods of changing market leadership, the strategy trailed the overall Dow index and, importantly, took longer to recover losses compared to the index.
Ouch. Not keeping up in the boom, slower recovery in the bust. What about more recent performance? This really gets to that still barking question.
This is maybe one of the most damning points, especially from a source published around 2000, looking at data up to 98, 99. It flat out states that those positive, above-average returns claimed for the dogs seem to be a thing of the past.
A thing of the past.
Yeah. And even more specific, this source calculated that during the most recent decade, they studied within their 1961-98 timeframe. So basically the 1990s leading up to 98, 99, there was actually a penalty, a negative advantage of negative 2.13% per year for the Dow Dog strategy compared to the DJIA. And that's before costs and taxes.
Wait, negative 2% per year underperformance, even before costs?
Exactly. The opposite of outperformance. This finding suggests that, at least in the decade right before that study came out, the strategy was actively losing to the benchmark, even on a gross basis. Factoring in the costs and taxes we discussed would make that after-cost penalty even worse.
That really throws cold water on the idea it's a timeless strategy.
It does. It raises a huge question about its effectiveness and relevance, not just historically, but specifically leading into the 2000s and potentially since. It supports the idea that maybe earlier outperformance wasn't persistent, maybe just, as one source called it, a statistical oddity that faded by the late 90s.
Which links to another criticism mentioned, data snooping. What's that about?
Data snooping in financial research is basically the risk of finding patterns in old data that look meaningful but are really just random chance, or specific only to that particular set of historical data. It happens when researchers test tons of different rules or strategies on the same data until they find one that happened to work well in the past.
So you're kind of mining the past data, trying keys until one fits the lock, but it might not fit any future locks.
That's a perfect analogy, like finding a trading rule that perfectly predicted coin flips last week, but it won't work next week because it's just luck. The worry with strategies like the dogs is that their supposed historical edge might just be data snooping, a pattern that looked good in, say, the mid to late 20th century, but doesn't reflect a real, persistent market inefficiency you can rely on going forward. Sources also note that journals and media tend to publish studies showing significant positive results, which can make these potentially random patterns seem more robust than they really are.
Okay, so maybe just a historical coincidence that looked good after the fact. And on top of that, could the strategy's own popularity have killed it?
That's another really interesting theory the sources raise. As the dog strategy got huge media attention, promoted by O'Higgins and others, it attracted a ton of money. Estimates mentioned are like at least $20 billion flowing into the strategy at its peak.
$20 billion? That's a lot of cash chasing just 10 specific stocks from a pool of 30.
Exactly. The theory is this concentrated buying pressure, specifically targeting those 10 high-yield Dow stocks right at the start of each year, it might have been enough to distort their prices.
How so?
If billions are flooding into these stocks just because they made the dogs list, it could push their prices up.
And if prices get pushed up, it reduces that undervalued or oversold angle the strategy relies on.
Precisely. The popularity itself might kill the anomaly. If everyone knows the strategy and piles in, the stocks might not be truly cheap anymore when you buy them. The advantage gets competed away.
So maybe the early good returns were real, but they were a temporary opportunity that just vanished once the strategy got too famous and too much money followed it.
That's the idea. Maybe it was a statistical oddity or a temporary inefficiency that got arbitraged away by its own success.
Wow. It's a fascinating feedback loop. Simple strategy works, gets popular, popularity ruins it, really shows how complex markets are and how hard it is to find simple tricks that keep working once everyone knows them.
It really does. Markets adapt. Exploitable edges tend to disappear as money flows in.
Let's cover a couple of other nuances mentioned before we wrap. First, portfolio diversification with this strategy. Is it well diversified?
Well, you are in large, established companies, but picking only 10 stocks from the 30 in the Dow means your portfolio might not cover all economic sectors evenly.
Right.
One source noted the 2019 dogs list, for example, only represented 7 out of the 11 broad market sectors you'd find in, say, the S&P 500. So you could end up concentrated in certain industries, depending on which stocks happen to have high yields that year. It's not automatically diversified by sector.
Good point. What about risk? Is it less risky or more risky than just holding the whole Dow?
One source looked at standard deviation, a common risk measure, measuring volatility for the dogs versus the DJIA over that 1961-98 period. They found the standard deviation for the dogs was 15.33%. For the DJIA index itself, it was 15.90%. Very similar.
So basically the same amount of volatility, same risk profile historically.
That's what that analysis suggested, yeah. No strong case based on historical volatility that it's significantly safer or riskier than just holding the whole Dow index.
Okay. Similar risk, debatable returns after costs, maybe faded effectiveness.
Sure.
So why is it still around? Why does it persist despite these critiques?
Sources offer a couple of ideas. One relates to maybe year-end market dynamics. Some think institutional fund managers might do window dressing.
Window dressing.
Selling off their underperforming stocks near year-end to make their portfolio reports look better, more aligned with benchmarks.
Cleaning up the portfolio for reporting.
Right. That selling pressure could potentially push some stock prices down, temporarily boosting their yields, making them dogs candidates right when the strategy looks at them, creating a little window of opportunity.
And maybe retail investors who don't need to window dress are better placed to exploit that, taking the longer view.
That's the thought. Retail investors can be more patient, maybe less swayed by short-term pressures, so perhaps better suited to this kind of annual rules-based approach. Sources also mention the idea of buying laggards isn't unique. A study on the Australian market found buying recent underperformers did slightly beat the index over a year. So the general concept has broad appeal.
It seems that intuitive appeal by good companies when they're cheap, plus the mechanical simplicity, just keeps it alive in conversation. And it's clearly still out there. Sources mention seeing how to invest using dogs of the Dow on TikTok today.
Yeah, that really shows its continued visibility. People are still finding it, asking about it. Though, as that source also notes, searching for dog content there often brings up, well, Dogecoin or actual pet care tips.
Light chuckle sound implied, but not written. Important distinction. But it shows that while it's discussed, really understanding what it is, what it isn't, and especially how it holds up under scrutiny is key.
Absolutely. The simplicity is appealing, but shouldn't obscure the complex reality of evaluating its actual effectiveness after costs and over time.
Which brings us to maybe the biggest single takeaway. One thing every source agrees on, whether they're pro or anti the historical claims.
Yeah.
This is a long-term strategy.
No question. Any potential success, if it exists, depends entirely on patience. Unwavering discipline. You must be prepared to stick with it year after year, follow the rules, do the rebalancing, and crucially, ignore the short-term noise, the volatility, the inevitable times the dogs will underperform badly.
You can't panic and bail after a bad year or two?
Absolutely not. That kind of behavioral discipline is maybe harder than executing the mechanics. Sticking with it when it's not working, especially when critiques suggest those periods might be common, that's tough.
The commitment required, through thick and thin, even when the dogs are really acting like, well, dogs. That's paramount. If you're not up for that, the strategy probably won't work for you, even if it had an edge historically.
That commitment is everything.
Okay, we have covered a ton of ground here. We started by defining the dogs of the Dow, that annual mechanical selection of the 10 highest yielding DJIA stocks. We looked at the theories, why it should work, blue chip resilience, buying undervalued assets, management confidence signals, market overreaction.
The whole contrarian value-based logic.
And we laid out those historical claims from proponents suggesting pretty significant outperformance over long periods.
But then we really dug into the critiques from the sources. We hit the challenges to historical data accuracy, like that bogus 1974 return, and the misleading effect of using arithmetic averages instead of geometric means.
Right, shrinking the claimed advantage significantly.
And crucially, we spent time on the impact of real-world costs. Those transaction costs from annual rebalancing 0.34% drag, 30% plus turnover, and the tax penalties from dividends and yearly capital gains. We saw how one source concluded these costs basically erased any pre-cost advantage over 1961-98.
Performing just in line with buy and hold after costs and taxes.
Exactly. Then we looked at the inconsistency, underperforming in the dot-com boom, the '08 crisis, and that really stark finding of negative 2% per year performance before cost in the decade leading up to the late 90s, suggesting the magic, if it ever existed, might have faded long ago.
We also touched on data swooping. Maybe it was just a pattern found in hindsight, and that fascinating idea that its own popularity might have killed the strategy by attracting too much money and competing away the edge.
So yeah, the strategy's appeal is clear. Simple logic, simple execution. But its actual ability to deliver superior returns after costs, after taxes, especially more recently, it's really subject to considerable debate and skepticism based on the analysis in these sources. And that need for immense patience and discipline holds true no matter what.
Definitely. This whole journey shows how a strategy that sounds straightforward can face really complex challenges when you analyze it rigorously, accounting for everything that hits an investor's actual results.
It's a great reminder that simple-sounding strategies can hide some tricky dynamics and costs you really need to understand.
So we'll leave you with this final thought. Are the dogs of the Dow still making noise today? Because there's still some genuine, maybe smaller opportunity there for value investors? Or is it mostly bark, based on historical patterns that don't quite hold up after you factor in the real cost? How does thinking about this tension between a simple, appealing strategy and the complex, sometimes contradictory data shape your own ideas about finding value? And what does the difficulty in proving or disproving even a seemingly simple strategy tell us about the market itself? Certainly gives you something to think about.